Welcome to the National Credit Awareness and Resolution Association podcast, your source for navigating debt repayment challenges during tough economic times. Today we'll explore how to effectively use Creditor Tools, specifically Guarantors. NACARA aims to bridge the gap between debtors and creditors as a paradigm shift allows debtors to propose their own repayment solutions. We'll share insider tips to help you leverage this knowledge and strengthen your position. Let's get started. Loans are underwritten based on the primary repayment source like cash flow, and a secondary repayment source like collateral, and a tertiary source like that may be the financial strength of any guarantors. Loans are not to be made based only on the strength of a guarantor, though. Guarantors, or interested or benefited third parties, are often included in the loan structure to help repay the loan should the debtor default on the payments. This generally includes guarantees for general partners, 20+% owners of a closely held corporation, owners of a startup company, or on U.S. Small Business Administration loans, SBA loans. Recourse or non-recourse. When guarantees are in place, it's considered that there's recourse to the principals. Guarantors generally are expected to sign fully, unconditional, or unlimited guarantees. If there are no personal or legal entity guarantees or guarantors on the loan, which has become common in the past few years, probably due to increased competition and lax underwriting standards, then the loan would be considered as non-recourse. In most cases where there are guarantees in place, the amount of the guarantee will be unconditionally 100% of the full unpaid balance, a joint and several obligation where every individual or legal entity that signs the guarantee is fully responsible for 100% of the loan amount, not just a certain percentage of the loan amount. Other guarantees may have limited recourse to the guarantor, though. A properly written and signed guarantee with consideration given to the guarantor. An owner or guarantor will realize that should the business fail, the creditor will come looking for full repayment. If a guarantee is executed, the owner or shareholder of the corporate borrower will be fully liable for debt repayment and will know of a certain psychological commitment. For the guarantee to be legally enforceable and worth anything to the creditor, the guarantee will need to be properly written and signed and consideration given to the guarantor. An actual guarantee is a very complex and detailed document and ensures that the guarantor must repay the loan if necessary. Creditors will be sensitive to those assets owned in and subject to the rights allowed in a community property state or in a trust. If they want such and such assets to be part of the guarantee, they will ensure the documentation includes the appropriate language and signatures from the appropriate parties and the trusts. So why is the guarantee risk important to you? Lenders expect both ability and willingness on your guarantee. Creditors will look to you, the guarantor, for financial support, particularly when and if the loan becomes a problem or a classified loan, when there are deficiencies with the repayment sources. You can expect to see a concerted effort to obtain current, detailed financial statements from you and any other guarantors, even if it's another legal entity, another business, and determine your ability to provide adequate cash flow support. This includes information about your income, assets, your liquidity, any contingent liabilities you have. These measures, however, are not only to document your ability to repay. Furthermore, to get any real repayment support, the creditors will have to assess your willingness to repay. Willingness is all talk until you write a check or offer additional collateral, etc. The lender doesn't know if you're willing until you do something about the problem. The creditor expects there will be both an ability and willingness to repay on the part of each guarantor. Willingness is manifested by performance, making payment when required or asked to do something. It's not just saying, sure, I'm happy to repay. Rather, it's actual payment, or maybe even a right sizing of a loan at renewal. You pay it down. That is demonstrated ability and willingness. This short ad is sponsored by the Debt Crisis Problem Podcast. Attention listeners, please join us at tunabudget.com to tune into the Debt Crisis Problem Podcast, where in plain English we discuss the 20 risks that could soon fuel a serious economic downturn. We explore critical risks that could trigger not only these downturns, but offer practical insights for navigating financial uncertainty. Join us for thought-provoking discussions that encourage transparency and awareness. Subscribe now to stay informed and be ready for whatever comes next. Getting a case of guarantor fatigue? Imagine for a moment a protracted a commercial loan workout scenario that involves default conditions and several negotiations with and payments paid by the guarantor, you. Have you ever heard of guarantor fatigue? When you guarantee a loan that has a troubled primary repayment source, like their cash flow is deficient, that you're expected to supplement, and it is either insufficient or heading that way, the creditor is going to come knocking on your door. At that early stage, you will probably be doing all you can to support repayment of what you hope and expect will be a short-term period of financial difficulty. So for several months or quarters even, you provide backup support and supplementing cash flow deficiencies to keep the loan current. You've demonstrated both an ability and a willingness to honor your guarantee. Good job. Maybe you burn through your liquidity, though, on hand and start to draw down on other lines of credit to come up with the necessary cash each month. Are you starting to get tired yet? You start to wonder how far this is going to last. The stakeholders all know that your personal financial statement has a considerable net worth. It may not be liquid, but there's a lot of equity, what have you. And now that you're burning through liquid assets, you question whether this is going to cut to the bone if you have to start liquidating personal assets to help support the commercial loan you guarantee. Do you see where this is going? Fast forward a year, and the business isn't able to keep up the payments and solve the reasons for there being insufficient cash flow. It doesn't look good. What are you going to do now? You clearly have a solid case of guarantor fatigue at this stage. You've burned through your liquidity sources, and now it's getting painful. You've been carrying the loan for a year or so, and you're getting worn out financially. To stand behind the loan you promised to pay as a last resort, you'd have to start selling assets. How does that feel? You were willing to do so when you borrowed and guaranteed the loan, right? But is that how you feel now? Why not? What's changed? What should you do? You have a choice. You need to be honest and stand up to your guarantee at whatever financial cost it requires. Do yourself a favor and read each word of the guarantee you signed before you make the choice as to whether you will honor it. Is that your signature or not? After reading it, what would you choose to do? Sadly, and probably in maybe even most cases, the guarantor is going to do anything and everything he can to avoid making payments and to pay the remaining loan balance. Wiggle off the hook, right? Even after the collateral assets have been liquidated. These guarantors would even spend good money to hire an attorney and look to make every excuse, like I said, to wiggle off the hook. Is that what you do too? Is that who you've become? Is this what you really want? Would you like your accounts receivable debtors to do that to you? What's the difference then? You do have integrity and honesty, correct? Here's what an honest person with integrity would do. Or would you do the right thing, like I said, and honor your guarantee? An honest person, a guarantor who was obligated to repay an unpaid debt, would approach his creditor. In other words, not get chased by the creditor, but would approach his creditor with a fully prepared current personal financial statement with supporting documents, and sit down and work out an arrangement whereby certain assets could be sold and the proceeds be applied towards the unpaid balance until paid in full. What if doing so meant that it would cut to the bone, as I said, and there was real loss of assets and real financial pain? Well, that's precisely what you gave your unconditional promise to do if the business loan went unpaid. Guarantors need to be honest to the core and fully stand behind the obligations they promise to pay. Do not sign a personal unconditional guarantee and an unlimited guarantee unless you're prepared to fully pay up with everything that's on your personal financial statement at origination and right now. Thank you for joining us. Today we covered the creditor tool, Guarantors, as debtors prepare to propose their own repayment solutions. But we want to hear from you. Share your own credit risk memo and debt repayment experiences, questions, inputs, recommendations with us at nicara.org. If you found today's episode helpful, please subscribe for notifications of future podcasts. Your feedback helps small businesses stay in business. Until next time, step forward and take responsibility for your own debt repayment solutions. Thanks again.